I'm Daniel.
And I'm Mira.
So it's Sunday evening, May 31st, 2026. You're probably gearing up for the trading week ahead. And, well, if you look at the market this past week, it feels exactly like a newly built bridge.
Yeah.
But instead of, massive steel cables, this bridge is being held up by fiber optic cables on one side and pure concentrated hope on the other.
Yeah, that's a pretty accurate visual, honestly.
Right. So today, our mission for this deep dive is to really pressure test that bridge. We're extracting the signal from a weekend of just, well, a lot of geopolitical chaos and tech euphoria, so you know exactly what baseline you're operating against tomorrow morning.
And just to set the ground rules before we dive into the deep end here, our discussion today is strictly for market context.
Yeah. Exactly.
We are here to analyze the landscape, synthesize the data, but this is absolutely not personal investment advice or, an investment recommendation.
Totally. So let's jump right in. Session 1. How did the markets move this past week?
Well, to understand the wild market movements we saw in this holiday shortened trading week, you really have to look at the underlying foundation.
Which is currently a massive tug of war.
Exactly. On one side of the rope, you have this relentless, seemingly unstoppable AI infrastructure boom that's just driving corporate earnings.
Oh, yeah.
And then on the other side, you have sticky oil-driven inflation fueled by all these global supply shocks. But this past week, the AI side of that tug of war completely dragged everything else through the mud. I mean, U.S. equities just saw an absolutely relentless bid.
Relentless is, it's truly the only word for it. The S&P 500 closed out its 9th consecutive weekly gain.
Which is just wild.
Right. I mean, that's its longest winning streak since December of 2023. It finished all the way up at 7,580.06. And the NASDAQ, that advanced to close at 26,972.62.
But the part that should really make you pause is the volatility, or rather the total evaporation of it.
You mean the VIX?
Yeah, the VIX. It plummeted to a heavily subdued 15.32. So the market isn't just going up, it's going up with this profound lack of fear.
And a huge driver of that lack of fear, it comes down to what's happening in the rates and credit markets. We actually saw Treasury yields drift a bit lower.
Right.
The 10-year yield eased down to 4.453%. And when rates stabilize or drop slightly like that, it just acts like a tranquilizer dart for the credit markets.
A tranquilizer dart is a perfect way to put it. Yeah. Because you look at high-yield corporate bonds, which are essentially the market's canary in the coal mine for defaults.
Yeah.
They didn't flinch. The ETF tracking those junk bonds, HYG, stayed anchored right at 80.31.
Wow.
And investment-grade LQD sat quietly at 109.36. What those numbers are screaming at us is that investors just aren't worried about defaults at all. The credit market is effectively pristine right now.
But here's where the narrative starts to fracture for me. Because while equities and credit are taking a nap on a giant pile of AI cash, the commodities complex is out there swinging wildly in the wind.
Oh, absolutely.
We saw crude oil suffer a sharp downward correction early in the week based on, hopes of a Hormuz deal. West Texas Intermediate settled at $87.88 a barrel, and Brent at $91.71.
And meanwhile, gold was giving everyone whiplash.
Seriously. Massive intraday swings before finally settling at $4,571.50. And the U.S. dollar index, the DXY, it softened just slightly to 98.94.
And if we look at how the stock market is interpreting that specific data, it becomes really clear why equities are so euphoric.
Yeah.
The equity market is looking at that temporary dip in oil prices, looking at the softer dollar, and pricing in an absolute best-case scenario. It's assuming the inflation threat is fading.
I have to push back hard on the market's complacency here, though, because it feels incredibly dangerous. Equities are treating this Middle East energy shock solely as an inflation and rates problem.
Right. They're completely ignoring any recession tail risks.
Exactly, because credit markets remain so pristine. The market is acting like central bank credibility as an inflation anchor is the only thing holding the entire narrative together.
Which is a massive blind spot.
It really is. So to wrap up session 1, the market is essentially coasting on tech momentum while completely ignoring these macro storm clouds gathering on the horizon.
Yep, that is the baseline we're looking at.
Okay, we're going to take a very short break, and when we come back, we'll dig into the weekend news and what it actually means for this fragile setup.
Sounds good.
All right, we are back.
So, moving into session 2. What were the key news events over the weekend, And what are their market implications under our contemporary macro context?
Well, before we dive into the weekend itself, let's briefly run through the watch next items from Friday's close that the market was already anticipating.
Good idea.
So for Monday, June 1st, 2026, at 7:30 a.m. Eastern Time, we have Fed Governor Waller's speech. Then at 8:45 a.m. Eastern Time, the S&P Global U.S. Manufacturing PMI final for May.
Right.
Following that, at 9 a.m. Eastern Time, U.S. construction spending for April and the ISM Manufacturing PMI for May. And finally, at 10:30 a.m. Eastern Time, the U.S. 3-month and 6-month Treasury bill auctions.
Okay, so that was the expected docket. But then the weekend actually happened.
Yeah, the reality check arrived.
Let's talk about the situation in the Strait of Hormuz and the broader Russia-Ukraine conflict. The facts are just, well, they're stark.
Very.
On Saturday, May 30th at 1:55 a.m. Pacific Time, which is 4:55 a.m. Eastern Time, an advisor to Iran's supreme leader publicly accused the U.S. of betraying diplomacy.
Which was a major escalation right out of the gate.
And it didn't stop there.
Yeah.
Later, Iran's top negotiator explicitly stated they have, quote, no faith in enemies' pledges. And then U.S. forces actually disabled a vessel in the Gulf of Oman.
Just, wild. And if that wasn't enough chaos for one Saturday, Ukrainian drone strikes hit Russian oil facilities in Taganrog and Armavir.
And a turbine building at the Zaporizhia nuclear plant.
Right. Though, to be fair, the IAEA did confirm radiation levels remain normal.
Thank goodness. A total disaster was averted there. But the economic implications of all these events are severe. What we are seeing here are compounding, unpredictable structural supply shocks.
See, I have to challenge that reflex, though.
The unpredictable part.
Yeah. Wall Street often treats these geopolitical events like unpredictable natural disasters, like a hurricane comes, it wrecks some things and passes.
Right.
But what we are witnessing with Iran and Russia is textbook geopolitical brinkmanship as game theory leverage. Neither side actually wants a clean resolution until maximum concessions are extracted.
The chaos is the point.
Exactly. The disruption is the leverage. So for the market to price in an imminent, smooth ceasefire is just highly misguided.
That is such a crucial distinction. You can't price a calculated negotiation like a passing weather system. The supply chains are actively fracturing.
Yeah.
But while the energy markets are dealing with that fragmentation, the tech sector is marching forward in a completely different reality. Over the weekend, the AI build-out moved from software promises to physical hardware.
Oh, man, yes. Late Friday afternoon at 4:40 p.m. Pacific Time or 7:40 p.m. Eastern, Meta outlined this highly aggressive hardware strategy.
Targeting 10 million wearable device sales in the second half of 2026.
Right. AI pendants, smart glasses, generative AI is moving directly onto the consumer's body. And then on Saturday morning, Dell CEO Michael Dell confirmed the launch of Dell Tech Plus and the Nvidia Vera Rubin NVL72 server infrastructure.
The sheer scale of the capital being deployed is staggering.
It perfectly illustrates this concept of AI CapEx as a cycle-agnostic arms race. These hyperscalers, Microsoft, Alphabet, Amazon, Meta, they are plowing over $700 billion into this space by 2026.
They honestly don't care if oil is at $80 or $100 a barrel.
Exactly. That massive spending is completely overpowering the broader macroeconomic headwinds, at least for the tech sector.
But the key word there is tech sector, because outside of U.S. tech, we're seeing a severe global macro divergence.
Oh, the China data.
Yes. Over the weekend, on Saturday, May 30th at 9:30 p.m. Eastern Time, China's official manufacturing PMI was released. And it arrived exactly at the stagnation threshold of 50.0.
Dead neutral. Factory managers are just sitting on their hands. And you pair that stalling global legacy manufacturing engine with Friday's coordinated chorus of hawkish Fed officials.
Right. Schmid, Bowman, Paulson, and Kashkari. All out on the wires, signaling that inflation is simply too hot to cut rates.
Right. So, wrapping up session 2. We've got a massive tug-of-war between a relentless tech hardware cycle pouring billions into the U.S. economy and fracturing global energy supply chains.
Which sets up a really tense dynamic. Let's take one more short break before we get into the calendar.
Sounds good. All right, we're back for our third session, so what should you watch in the coming week?
Well, based on everything we just recapped, the incoming data deck is critical. We already mentioned Monday morning's ISM Manufacturing PMI at 10 a.m. Eastern Time.
Right.
Then Tuesday, June 2nd at 10 a.m. Eastern Time, we get the JOLTS job openings and quits for April.
That's going to be a big one for wage pressures.
Definitely. But Wednesday, June 3rd is a packed morning. It starts at 8:15 a.m. Eastern Time with the ADP National Employment Report.
Okay.
Then at 9 a.m. Eastern, there's a discussion with Fed Governor Barr. At 10 a.m. Eastern, we get the ISM Services PMI. And then at 10:30 a.m. Eastern Time, the EIA Weekly Petroleum Status Report.
Which is going to be highly scrutinized given the Hormuz situation we just talked about.
Exactly. Moving to Thursday, June 4th, at 8:30 a.m. Eastern Time, we've got initial jobless claims, continuing claims, and the Q1 final productivity and costs.
And then Friday is the main event.
Yes. Friday, June 5th, at 8:30 a.m. Eastern Time, the Critical May Employment Situation Report covering non-farm payrolls, the unemployment rate, and average hourly earnings.
Wow. Well, it's Sunday night, which means it's time to decide if we're dressing up as an AI hardware engineer or a geopolitical crisis negotiator for tomorrow's open.
It really does feel like a split personality market.
It is. We just spent the week buying Meta's new AI pendants and cheering on Dell servers while casually ignoring drones buzzing around nuclear plants. The market is basically a teenager right now, blasting tech earnings at full volume while pretending the Fed's inflation curfew doesn't exist. Let's just hope that fragile Hormuz ceasefire holds, or we might actually have to care about the price of gas instead of just the price of GPUs. Remember to plug in both your smart glasses and your anxiety blanket before Monday morning.
The anxiety blanket is definitely mandatory equipment at this point.
Absolutely. Okay, so for those who stick around, we are now moving into our live, public, 2-minute paper trading segment.
Right. So we launched this experiment on April 17th, 2026 with $10,000. Going into Monday, the portfolio sits at $11,198.15.
Not bad at all.
No, it's an 11.98% return, which is completely crushing the S&P 500's 6.37% return over that exact same time period.
Okay, I'll pitch my trades first. Based on what we've discussed, the market is wildly pricing ahead of physical reality on this Hormuz deal. So I propose we sell $600 of our technology ETF XLK and $419 of our discretionary ETF XLY.
And your justification there?
Well, because discount rates are financial gravity, and the Fed is holding rates high. Plus, energy shocks are a delayed consumer tax, which will crush discretionary spending. I want to take that capital and buy $1,019 of energy XLE to really fade that premature oil dip.
Interesting. Well, I agree on buying energy and selling discretionary. But I want to add a decision to completely liquidate our materials exposure, selling our $399.31 position in XLB.
Just totally out of materials because of the China PMI.
Yes, exactly, due to China's stagnant 50.0 PMI. But I am going to push back hard on your tech sell-off.
You don't buy the financial gravity argument.
I buy the gravity, but you can't fight the CapEx cycle. The Dell and Meta hardware launches are proof of this structural build-out. So I propose buying $432.57 of tech, XLK, instead.
Okay, fair enough. We have competing views on tech, but alignment on energy and the consumer. Let's aggregate the final blended decisions executing at Monday's close. We're going to sell XLB, which is 1.8% of the portfolio. We'll sell XLY, reducing it by 3.7%. We'll have a net sell of XLK of just 0.7% of the portfolio, balancing our views. And we'll buy XLE, increasing our energy position by 6.3% of the portfolio.
And here is the mandatory disclaimer. This is a live paper trading experiment. It may fail at any time and is absolutely not financial advice.
Perfect. Well, to wrap up tonight's deep dive, I want to leave you with one final thread to pull on as you watch the markets this week. Given the massive, almost insatiable power requirements of these next-generation data centers, what if tech capex is actually masking a broader fragility?
You're talking about the physical limits of the grid.
Exactly. What if the ultimate reality check for this historic bull market isn't the Fed or inflation, but simply energy access as the bottleneck for AI? If the power grid physically can't handle the load, that shiny AI bridge we talked about earlier might just run out of structural runway.
It raises a profound question. We'd love to hear your thoughts on this bottleneck and your own weekend trade setups down in the comments.